Okay, good morning, everyone, and welcome to this morning's Coffee Microcaps Morning Meeting. You're all very welcome to this morning's event. My name is Mark Tobin for anybody who is joining us for the first time, and for any of our regular attendees, you're all very welcome back to this morning's session. I'm just going to quickly run through a couple of intro slides here quickly, and then we're going to get straight into it with our first presenter. I'd quickly like to mention RAS Research as a Service. If you are looking for some institutional grade research on some smaller microcap names, probably not covered by some of the sell side brokers, please do check out their website for that free research. And indeed, Pointerra, our first presenter this morning, is covered by RAS. A quick compliance and disclaimer slide, and a warm welcome to our friends from ASIC if you're joining us this morning. For anybody who is joining us for the first time, the companies we typically have presenting on here, generally every second week we have an event capped under 300 million, our definition of a microcap in the ASX context, generally in revenue, approaching cash flow break even, or indeed are already profitable. We tend not to have companies from the resources and biotech sectors on here. What I like to call industrial microcaps, which covers technology, healthcare, financial services, professional services, and hardcore industrial companies generally. Structured this morning's meeting, we've got two companies joining us this morning. Each company is going to have a 30-minute session, which will break down into a 20-minute presentation, 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. It just makes it easier for me to moderate the questions as we go along. And please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel tomorrow morning. You can follow us pretty much on all the socials. Twitter is our main one. YouTube, as I said, for the recording of this, and indeed all our previous events. We've done well over 100 now, 200 individual companies. So if you're looking to research some ASX microcaps, please check out the back catalogue there. LinkedIn, and I do write a free monthly newsletter that this month's edition just went out earlier this week, which you can get on the Substack platform. Our two companies this morning are returning companies. I'm delighted to welcome back Ian Olson, who's joining us early doors from Perth. And don't say we don't cover the ground here in Coffee Microcaps. Once Ian is done, we'll flip over to Brisbane and we'll have Dennison Hambling back with us from Intelligent Monitoring Group. But that is enough from me, so I'm going to stop sharing my screen. And Ian, if you want to just bring up your presentation, I will let you know once I can see your
I'd love to, mate,
slide.
but I cannot see the screen share piece at the minute.
It
It was
should
working so
be
well before.
either along the bottom of your screen
Hang on,
or
here we
along
go.
the top.
Here we go. Yeah,
The nav bar is a
well
bit
done.
dynamic
Well done.
on Zoom. It tends to bounce around. Yeah,
How's
it's
that?
loading now. Yeah, you're on slide 5 of your deck there.
Perfect.
Okay.
Perfect. Okay. Right. Let's get this out of my screen. Thanks for that intro, Mark. And great to see so many familiar names and participants today. And thanks everyone for making the time to hear our story. I'm going to jump straight into our Q1 results and forego the intro, which talks about our business model, our platform, and our growth strategy, because my sense is a lot of you already know that story and have heard it before, and are interested in having a deeper dive on the quarter. So, I guess in summary, it was a pleasing quarter in some respects. We had good customer receipts and a cash flow positive quarter, albeit aided by the annual R&D rebate we get from the feds. We left some money on the table. There were some uncollected receivables, which is good and bad. It rolls into this quarter, Q2, and with the momentum we've got from some of the announcements, some of the existing contracts and customer growth, we're expecting a very good Q2. So we'll look forward to reporting on that in the new year. But the theme is very much for this quarter, contribution across multiple sectors. So what does that mean? Well, for those of you who've been with us for a while, you'll know that we've talked a lot about the US energy utility sector and how important that's been to us. And of course, calendar 22 and calendar 23 in the US were difficult or challenging for us, as some of those programs were put on hold for a number of different reasons. But as we've been discussing in the past few quarters, that hiatus, if you will, is very much ended, and we're seeing a lot of activity across our energy utility sector customers and prospects. And what does that mean? It means that they're out capturing data, flying and driving their networks, and then they're using that data to interpret the health of their network. And that's for situations and risks like vegetation encroachment, responding to storm events, and most significantly, assessing the engineering position or the engineering state of their existing pole and wire network, so that they can figure out how to spend many hundreds of billions of dollars across the country to it's come via way of the Biden administration's Inflation Reduction Act. And that oddly named act, as we've discussed before, hidden within over $1 trillion of expenditure, is a sizable investment by the US federal government into civil infrastructure in the US. So not just poles and wires in the utility sector, but across road and rail and water as well. And for us, that's a fantastic structural tailwind. It's bipartisan. And so what does that mean? It means that the incoming Trump administration's unlikely to unwind that element of that act. I think it's we'll leave it up to the pundits to debate what that'll actually look like. But anyone who follows civil infrastructure in North America knows that the country has underinvested over the last 20 to 30 years in its road, its rail, its power, and its water network. And that underinvestment is causing economic problems. It's causing GDP problems, as well as obviously safety and continuity of supply of critical services, in particular water and power. So it's no surprise that we targeted the energy utility sector as early as 2018 when we entered the US market and started operating there. And again, those of you who've been with us for a while will have seen our journey. And what's pleasing this quarter in particular was that whilst we've seen a recovery in the US energy utility sector, and led by our foundation or our anchor customer, Florida Power and Light down there in the southeast, the contribution from Australia and from other parts of the world in non-energy utility sectors, in particular mining and oil and gas, was particularly pleasing during the quarter. And what we've done over the last couple of years is taken the learnings from the development, the product roadmap, if you will, of Pointerra 3D and our digital twin solution for and how we've developed that in response to customer demand in the energy utility sector. And we've taken those learnings and we've applied them to our product roadmap for road, rail, and power and water. And again, a similar roadmap to a similar path that we took with the back in 2018 with the energy sector. We're having some really good wins in Australia. A lot of the state DOTs are now Pointerra core customers and are moving into Pointerra Analytics and growing their spend, growing their commitment, recommitting, and in some cases we've had some East Coast DOTs and rail networks that have been customers for many years now. More recently, we've across mining and oil and gas, we've been involved in operationalizing the use of remote sensing equipment, so drones and planes and helicopters flying and vehicles flying and driving mine sites and pipelines and rail corridors, and really a focus on process infrastructure as well as production at the mine site. Again, working with our customers, and most of them are tier ones across both mining and oil and gas, in helping them operationalize the use of the remote sensing hardware and living the Pointerra Simply Faster theme, which is, we know you captured this data, we know it's difficult for you to get timely answers from it, and that's what we do. We help you shrink the time it takes to get the answer from that valuable data and the big investment you're making in the capture hardware. Again, working with those customers to develop and build out the analytics stack. So it's a theme of understanding, once we've got all their digital twin data in Pointerra 3D Core, understanding what their workflows are, then what do they want to know, how do they want to interpret and analyze that data on an ongoing basis. So again, working closely with our foundation tier one customers in mining and oil and gas, building out the analytics stack, growing their spend, growing the number of concurrent users, and that's really our North Star metric, which is our daily active users, and something that we chart internally as a measure of the activity on the platform. And pleasingly, that a lot of those mining and oil and gas companies are obviously part of global operations. So with a couple of miners and now an oil and gas company, we're being deployed across multiple sites, multiple facilities on a global basis, and so it's a nice gradual rollout that leads to a seven-figure enterprise subscription in the medium term. And again, lots of lessons learned from the energy utility sector. So that's the quarter was it wasn't just dominated by the energy utility sector. It had great contributions from rail, from road, mining and oil and gas, and of course our very important survey mapping customers continue to grow and expand. We've got people signing up to the platform. 6 to 12 months ago, maybe 2 years ago, we'd get maybe one a month sign up, and then a year or so ago it was one every week or two, and these days people signing up to our trial account where they can put their credit card in and become a customer and get going without needing to speak to a human. That's down to, we're seeing multiple sign-ups to trial accounts each day. So it's fair to say that the name and the brand and what we do has got global recognition, particularly in the survey and mapping space, and particularly in the North American market. And I'll come back to some developments in the North American market and our US operation later in my presentation. The second point on this slide here on the left-hand side, I think is really important for us. Obviously, we disappointed ourselves and the market in relation to revenue and cash flow generation throughout FY23, the second half of FY23, and then most of FY24. We enter FY25, and obviously we're partway into the second quarter now, with more won and undelivered work than we've had in recent years. And what does that mean? Fenola's got some numbers out that we're not unhappy with around FY25, and a vast majority of that revenue and cash flow is underwritten by existing customers and existing contracts. So I'd like to think we can surprise people on the upside, and if anyone hasn't had a look at Fenola's latest research, I'd commend that to you. And she's been following us for a while, and has worked really hard to understand the business. So yeah, I'd like to think that when we speak to you guys next on this forum, maybe in Q3 or Q4, we'll be able to talk with some confidence about a real outperformance year and a material turnaround from FY24. At the start of the conversation, I talked about the structural tailwinds, the US energy utilities, transport agencies that are launching their decade-long multi-billion-dollar capex programs. We made an announcement late last year about actually it was more like August, I think, about one of the big US energy utility customers, Entergy, and our role there, and what we've learned over that journey, and we're still really well positioned there for that project, and waiting, is that the sheer size of the investment that these utilities, and not just energy but road and rail as well, that they're making is unprecedented in their history. As you'd imagine, a lot of these civil infrastructure utilities have grown with the population over more than 100 years, and they've added incrementally over time to investment in their network, and now they've had to rely on the traditional debt and equity markets in many instances to fund that growth. What they're looking at now is an unprecedented level of assistance via the US federal government initiatives, and that amount of money is needs to get into the ground. And there's not panic across the sector, but there's a degree of uncertainty across the sector about how to actually get that money in the ground. So there's capital, and there's a thing to do, but in the middle are people and materials, and that's the gap at the moment. There's simply not enough people, either at the utility level or their prime contractors, to execute this all at once. And so our theme and our role, the role we think we play, and it's a really important role in helping these projects get underway, is demonstrating and leveraging out the work we've done with FPL, demonstrating that the use of Pointerra 3D can help them plan successfully for that capex program, and then execute successfully by giving them a snapshot at a moment in time of the health of their network, and then helping them plan and prioritize where to start to deploy the capital. When you're trying to spend tens of billions of dollars over millions and millions of power poles across hundreds of thousands of square miles, it's you're really flying blind, and the capex programs can blow out in terms of program and cost. So we've got we believe, and we've been told by our customers, that we've got a really important role to play in helping those customers and those prospects execute on those programs. It's the most important part, I guess, of this business in the short to medium term, particularly our US operation. And we've done a fair bit of soul searching over the last year or two about why we haven't been able to sustain the growth that we saw in calendar 20, calendar 21, and the first half of calendar 22 in the US. We made some changes in that business. We made some changes in relation to our go-to-market strategy, augmenting our direct sales model with channel partners, and they are traditional consulting firms, organisations like Deloitte and Accenture, and then the industry sector players who are people like Hitachi and IBM and General Electric and others, who have specific solutions that are tailored for specific sectors, and need to add on third-party solutions like ours. So we're not, we're a lean organisation. We're not a systems integrator, but we love working with change agents, people who are conducting digital transformation strategies at the highest levels in multinational companies, in undertaking that digital transformation strategy. They are by very definition looking to deploy solutions to drive efficiencies. And I've talked for a bit now, but the theme is reducing the O&M, so operations and maintenance expenditure, which improves earnings per share, and then optimizing the sustaining capex investment. And that's the role we play. We're simply faster. Yes, we shrink workflow and we help you interpret data and build a digital twin. But what does it all mean? It means that our customers can save money on their annual P&L, and they can save money on their capex programs. And we've done some modeling with some of our bigger customers and prospects, and fully deployed across the enterprise. Pointerra, a $5 million annual investment in Pointerra can save $100 million in O&M annually. So there's sizable savings, it's sizable ROI. We've had those ROIs and tested and evaluated by internal teams. And so it should be, and armed with that information, you'd expect that enterprise sales would be super simple, and they haven't been, and that's been a challenge for us. So we've made some changes as well, and brought in some new leadership into the US operation to help that team there. And I know Brian's on the call, but we were delighted earlier in the week to have a chap by the name of Brian Mayfield join our US business as the CEO of Pointerra US Inc. And he brings a real track record and a pedigree of growing and exiting geospatial businesses over his career. He's been a customer of Pointerra since circa 2018, so he knows the platform, he knows the product. Like a lot of us in the business, he's come from the geospatial services sector, and become frustrated with some of the challenges of operating those businesses, and understands that if you can build a pure workflow solution and not be involved in capture, which is highly competitive, high capex, low margin, then you can build a really profitable high growth business that delivers really superior margins. So we founded this business back in 2015-16 with that view, and I actually shared a whiteboard scribble that we did in, I think it was 2016, so 8 years ago, where we described the market in terms of the people that capture the data, the people that use it, and then the people that own and operate their businesses across our different sectors, and where we thought we fit. in terms of non-enterprise customers, enterprise customers, and channel partners. And that whiteboard picture from 8 years ago is as relevant today as it was then. So pleasingly, our view of where we fit in the market is unchanged. And what we need to do is learn from the challenges and the mistakes we've made over the past 3 or 4 years in particular, and make sure that we bring quality people into the business, particularly around enterprise sales and leadership in different jurisdictions. But as I look across our business today, and I think about where our customers are and where our prospects are, there's not a continent on the planet where we're not deployed or being deployed. And there's not a continent on the planet where we're not looking at sizable 6- and 7-figure recurring ARR subscription opportunities. So that's easy to say, and I've got the ability to look at our pipeline and just see how massive that is. What you guys see is what we spit out quarterly on a half-year basis and a full-year basis, and we know that we need to turn that pipeline into results. And the team, the founder team, are still here. We're aligned with you, and we're really excited about some of the changes we've made in the leadership across the business in the last 6 to 12 months, and some of the investments we've made in channel partners. And it's fair to say that the people that we're working with, the brands that we're working with in that channel partner community and reseller community, even 2 or 3 years ago, really didn't know who Pointerra was, and I guess it's testament to the people in the business and the people that have been in the business over the journey that have helped grow that brand and product recognition across the market in multiple jurisdictions. And to the point now where it's a long bow to say you're a household name, but certainly in the geospatial sector, we're very well known. Everyone understands where we sit. And increasingly, our survey and mapping customers, in particular, are helping the viral growth of our platform by using our platform to deliver data to their customers. So a lot of the growth that we're seeing in the sales pipeline for asset owners across road, rail, power, water, mining, oil, and gas are coming through the sort of virtuous flow of data in terms of our survey and mapping partners who are Pointerra customers, delivering data to those end users who are saying, hey, maybe we need this platform for our business. And so it really feeds into that the theme of our product theme, if I go a couple of slides up, about the digital twin as opposed to just a place to store data. So the survey mapping customers are very much massive users of Pointerra 3D Core. The asset owners are bigger users of, whilst they need Core to contain their digital twin data, they're really very much into the analytics and the business intelligence stack. So again, that product stack that we came up with a couple of years ago has been tested and is as relevant today and going forward as it was when we imagined it. And it's certainly resonating with our customers and our prospects. And I couldn't be happier about the changes we've made in the business in the last 6 to 12 months. And there's a few more changes to come over the next month or two, which I think the market will find quite interesting. And really, we couldn't be more excited about, at a really granular level, about FY25 relative to the last 2 fiscal years. So we think we can perform and meet expectations and potentially exceed them as it relates to some of the research that's out there on us. And I really look forward to reporting on that. So I've used 22 minutes banging on about the past, and you've all heard enough from me, but I'm sure there's a ton of questions. So Mark, do you want to throw those at me?
Yeah, and there is a ton of questions, so I'm going to apologize ahead of time because we're definitely not going to get to them all. Just to clear up one quickly, and Ian is referencing Finola. That's Finola Burke from RAS Research, in terms of I mentioned at the top of my intro, who does cover Pointerra. So when he's talking about Finola's research, that's who he is talking about, and that cover one question. Another question is just there's actually a few, and it's related to individual contract announcements that you've done, Ian. So
Yep.
maybe give us like a 1, 2 sentence answer on
Sure.
integrity, the rollout there. Somebody saying, they've kind of pushed the go button in some of the Gulf states like Arkansas, Mississippi, Louisiana in
Yep.
the recent weeks. And then Amazon was another one where, from
Yep.
memory, you guys, I think, did a pilot with them, and then it was kind of an expanded pilot, like just kind of where things are up to with them.
Sure. Yep.
And then Velocity, I think, was another customer, which I'm not 100% sure
Okay.
on, maybe.
Sure. All right. So Entergy, I talked about at the start of the presentation. They're still in the planning phase. They haven't done a system-wide capture yet. It's great that there are people on the ground that have got an insight onto pressing where the go button might have been pressed. It's a 10-year program. We're really well positioned. The people that are advising the C-suite and advising the prime contractors have placed Pointerra right in that process. So we're as with a lot of opportunities, we wait for the data to be delivered so we can do our job. Amazon, we had a contract award of just over I think it was $1.25 million US. We've only done about 20% of that project, so that's still a live project. They put it on hold while they went through a restructure. There's still a live opportunity, and it hasn't gone away. Velocity are Amazon's prime IT contractor, so Velocity do the doing for Amazon. But in this instance, we're working directly with Amazon, although we do continue to work with Velocity in relation to their Amazon relationship.
And then another, let's say, contract-related one, uh, pilots testing with the US military.
Sure.
Maybe give us an update where that
Yeah, actually, the
opportunities are.
DOE. I haven't talked about the DOE project, and but that's remiss of me because it's not staring at me in the face on slide 5 here. But the DOE project we announced, I think, late June. Where that project's commenced, the data is being collected as we speak. I'm at a project meeting in the second week of December at the University of Connecticut in just outside of Hartford. And just a quick recap on the project. The DOE awarded Pointerra as a prime contractor for a consortium of 3 northeastern utilities and 3 university partners, and it's quite a simple project in many respects. We're capturing some data of the existing networks, a very small amount of data. In relation to, I think it's less than 100 miles for each utility. We're building a digital twin using Pointerra when we get that data, and then we are delivering the results of our findings, which is what's the condition of the network, to the universities who are undertaking independent economic analysis and the objective is to compare the way utilities have approached capex deployment using traditional means versus a pure digital play like Pointerra. It's not a lay down, but we're pretty confident that the results will come out in our favour. And the objective there with the DOE's backing is to then have the US Department of Energy say to the to the US energy utility sector, hey, if you're undertaking climate change related resilience investment, and we know they are, then if you're not using Pointerra as part of that process, you're not adopting best practice. So for us, we talk about structural tailwinds. The capital's there, and if this project, and it'll be finished sort of back end of Q3, so back end of March. Out of that, we'll have one of the largest US government agencies saying to all the energy utilities across that country, hey, you should be using Pointerra. So for us, it's something we dreamed of many years ago and in fact, we started to dream about because one of our customers said, if you guys play your cards right, you could become a standard that is mandated. And there are standards, there are platforms and solutions that are mandated for use across the US energy utility sector, and that's the prize for us. So we're excited about that opportunity, about that live project. We're really confident that we're going to get the result that we expect, and then it's up to us to leverage that endorsement from the US Department of Energy, and that's that's not just going to be a North American outcome, but the utilities around the world look at what the Yanks are doing, and I expect will it'll help us with our energy utility sector globally.
Another question then, you referenced Brian, the new US CEO. Just a question on,
Yes,
is Brian's appointment going to help to free up your time to focus more on the ANZ market, and Brian will be kind of focused on the US market, obviously, feeding back to you, and you guys will be working closely, but
sure,
maybe just kind of define, what this means for Brian and for
sure.
your role more broadly, I think is the
Yeah. So what we've learnt is that the Americans, and we love them, they're our friends, our colleagues, and what we've learned is that they like hearing their own accent more than they like hearing the Australian accent. So Randy has our spiritual leader has done an incredible job of taking us from an idea to a company with real presence in that country, and Brian just brings another layer of leadership, of commercial experience, and he will be helping me. We've got a really flat structure at Pointerra, so it's a team. My job isn't that people report to me; it's just to support them. So as Brian's been coming up the curve this week, it's my conversations with him are, how can I help you? How can I help you succeed? So we couldn't be happy. I mean, we wouldn't have, 2 or 3 years ago, Brian might have been a customer, but I don't think we would have been able to, to convince him to come and run our business. And so for the people that have been with us in the Pointerra US business across the journey, a lot of the reason why Brian's with us is because of the contributions they've made and the presence we've got in that market. So it's a massive opportunity for us, and we're delighted to have him.
Then another question just on the cash flow itself. It says outgoings were kind of circa 4 million in the previous quarter versus 3 million on, if you take an average over the last financial year. Is that, due to, annual bonuses or, insurance premiums? I know a lot of companies have a lot of one-off expenses that,
Yeah.
get paid in July for the kind of coming
Yeah.
financial years. Is it something related to that, or?
Yeah, look, I think our cash flow, outgoings run rate is well under what we think we'll do for revenue and cash flow this year, but it is lumpy, and that that's in and around our ATO obligations, superannuation. Insurance isn't a massive line for us. It's if we're running a huge amount of data through AWS in a particular quarter, as it's a bigger spend to use compute than it is to use storage at AWS. With some projects, we have third-party contractors where that spend might be bigger in a quarter than it was in the previous quarter. So there's no real theme. I know people are building models and want to really dig into each quarter's spend, but we've been pretty consistent, and in demonstrating that we know how to be reasonably fiscally mature and responsible when it comes to managing the cost base of our business relative to the income inflows. And we got caught out in the last year or so, and that cost us, and it's cost shareholders because we had to go and raise some money, which is disappointing. But we'd like to think that that journey's behind us now, and we're back to being the self-funding growth story that Pointerra was perceived as being by the market in 2021 and 2022.
Okay. Ian, we've gone slightly over time, and apologies to anyone if I didn't get to your question. We just got a bit swamped with questions, but thanks everyone for joining us.
I'll grab those questions off you, Mark, and we'll do our best to respond to them and then post them give them to you to post on your website or append to your YouTube presentation.
I'll send them across, and maybe you can integrate him into the next deck. I think is probably the easiest way to do it.
Perfect.
So Ian, if you could stop sharing your screen, and we're going to flip from West Coast to East Coast, and we go to the lovely Bris Vegas, and have Dennison Hambling from IMB joining us. Dennison, if you want to, good morning. First of all, if you want to start
Thanks, Mark.
sharing your screen, I'll let you know when the cover slide of your deck is up.
Let's try and figure out what screen. Right, there you go.
Yeah, it's loading now, Dennison.
Perfect.
Yep, I can see the cover slide now, so you can take
Great.
it away whenever you're ready.
Let's roll. So one correction being I'm in Victoria today, so
Ah,
but that's okay.
still East
Look, I'll
Coast.
quickly sprint through today. There's probably a couple of key points, really, I'm sure people will want to touch on, and we'll get to those, but I'll do it by way of presentation and try and move through fairly quickly in the first instance. So I'm not sure if I'm scrolling that particularly well. Just the basic overview as usual. So we're now the leading provider of monitored security solutions in Australasia, over 200,000 businesses, homes, individuals. Got a very strong recurring revenue base, which feeds nicely through the business and gives us our underlying strength. And that core base of businesses got a very good gross margin. Approximately the 32.6 mil of revenue of EBITDA from last year, which if we had had ADT last year would have been 34.8. Very clear in terms of what our growth areas and strategies are. As a result of the history of the business, which has been well documented and will quickly pass, we've got a lot of tax losses, which we expect to put us in a good position to burn off over the next couple of years. I'll turn to guidance first, and I'm sure it'll come back to it in the questions, but recently put out guidance that we expect to earn over 38 million in underlying EBITDA for 25 prior to acquisitions. It's a notable feature for us in that there's a little bit of noise in that related to the historical, workflow of the business. And so we acquired ADT Australia in August 2023. We had it for 11 months. Through that time, largely the business was focused on converting its existing customer base from 3G, being on 3G communicators, to 4G. It was a pretty serious project. You will have all read about the shutdown of the 3G network, which I don't believe is actually shut down yet, albeit it's been officially shut. What that meant for security amongst a lot of devices is the 3G network in particular was quite important for those devices to actually work. And so when it shut down, if you didn't do those conversions, your actual alarm systems wouldn't work and would shut down. For us, we walked into that process underway. When we walked into it, the prior owner had already pre-committed to a decent amount of upgrades from 3G to 4G at prices that we didn't want to do, I guess, or didn't do going forward. So in the first instance, when we took over, we repriced all that work to make it cash neutral to us as a business. Again, a huge project. You're talking about 50,000 customers you have to transition over the course of essentially a year or slightly more. So the net effect of the 3G project last year was an operating sort of cash loss of about $3 million. That loss was related to the pre-committed sort of work that we did walk into and sort of really affected us for the first, I guess, quarter of our ownership of ADT and second. Then what we were left with was just a transitioning work. And from a practical point of view, what it meant is that all of our, especially in the second half of the year, all of our service coordinators, all of our installers, all of our sort of efforts and energies were largely directed to just getting those 3G customers converted. It obviously, you do it because it supports your underlying recurring revenue and cements the base for the business and essentially refreshes your customer base too, which is effectively what we've done. What it meant in practical terms, though, I guess looking at the way the business, it flowed through the business was because the old ADT customers were on essentially like a leased arrangement. So it's called ADT owned, was the way that the contracts used to be written. Now, they haven't been written that way since we've owned the business. We stopped that on day one we took over. What it meant is that any changes, a lot of the change costs were capitalized, and then then they get amortized over 5 years because the customer life is usually sort of averages 7 to 8 years for an alarm system. So what it meant as you look back on the business is that if you took the view that there's no 3G work moving forward, which there isn't because the 3G conversions have largely finished. I would just add there are a few thousand, less than 3,000 customers still who haven't yet sort of essentially decided what they're going to do one way or the other. So it might tail a little bit in our accounts for another month or two or three as that sort of unwinds, but essentially it's done. If you took the view that was essentially EBITDA last year and you took it out of EBITDA, it had an effect of about $7.9 million positive in the 24 account. So, if you wanted to, you could say, what we'd said is you take the 7.9, that's sort of the base of the business. Now, that's a very pessimistic kind of way to put it, because obviously if we weren't doing that work that ultimately didn't generate any real cash flow last year, we would have been doing the profitable work that we're doing now, both in servicing our existing customers, but also growing. But effectively, I wanted to try to get away, and I'm not saying it's a great way to do it, to sort of underlying point to the fact that, we're actually growing the underlying base as we move forward in a really profitable and cash flow positive way. And so, in essence, we put out that $38 million of guidance that now has ended the ADT-owned experience. We actually, in July of this new financial year, have essentially handed back the security systems to the customers and said, actually, those contracts aren't in place anymore. It doesn't really have much of an effect on us, but what it does do is it does stop, I guess, that accounting treatment, which was just Skip's accounting treatment, and it means that we, finally have a business that, really does have a pretty straightforward revenue through costs type function. And so 38 mil of underlying EBITDA, and we're saying greater than that, is just to set ourselves a base so that we can move forward. But I think what will become apparent as we move through this year and certainly into the second half of the year is what that really means for an underlying level of growth. And so I appreciate it's a little bit noisy, and I'm sure I'll take questions on it later. But I think as we move forward, what will become more apparent is it'll be a much better cash flow year, and everything will actually sort of normalize out, and then ultimately we'll be able to talk, much more excitingly about growth. So I'll keep moving on, and I'm sure as they come back. Board and business, we've passed this before, but effectively we're three divisions: ADT, split into New Zealand and Australia. We've got Signature Security Group, which is sort of really our resi small commercial focused business. And then Intelligent Monitoring Solutions, which is our wholesale monitoring provider to the industry. In terms of the growth opportunities, and they really sort of come in a phasing over time. We've got commercial and enterprise. And so the first big engine we've got, which is really, kicking into gear for us substantially, certainly now, but has been over the last few months, and as we look into this year, is the commercial and enterprise space, where we are quickly becoming the preeminent provider of security solutions to enterprise and large commercial type customers in Australia. And so our real focus in the last 3 to 6 months has been rebuilding a network there, and we've done that, both through organic work, but also through acquisition, to have a footprint now that puts us north of 100 technicians across Australia, with only a few real sort of pockets that allows us to service, the biggest customers across the land, and really drive technology solutions into them in a way that they've been looking for. So the goal there is to get back to 130 million of revenue from the business that probably is more like 50 million today post the acquisition of DVL, but has lots to go and is growing very strongly organically. And so we are really focused on the underlying organic picture this year, and then anything else, we'll sort of supplement on top. The resi story and care are ones that come through more as we look out over the next 12 months and beyond. Residential, this is the year we expect to start to see it move forward. I'm happy to say ADT Australia's customer base grew last month. This is really focused to the new security systems that we've brought in that are much more customer friendly, much more easy for the customer to interact with themselves, to put in place themselves if they want, which reduces the cost of them up front, which allows us to drive penetration and ultimately will allow us to what I think is heal the security solution for residential security in Australia, with the use of video as well, such that we want to see penetration in Australia start to move up from the 5% levels currently to the 30%, and then into ADT care, which we won't talk about too much today because that's sort of a longer piece of work that we're working on. Last couple of years have been really important because we've got our platforms in place, and so it's been really important to me. I mean, I've personally, I guess, driven this business to make sure we're prepared to be able to move forward at all times. That includes making difficult decisions around integration and making sure that when we have acquired, we worked very quickly and carefully to integrate so that we've got an actual platform that is pretty cohesive, that knows what it's doing, that is able to interact, and with access to technology. And so, we've got some pretty key relationships developed now with leading global products and providers that will allow us to now take our sort of message forward into the world. In particular, and to be honest, for me personally, this is the most exciting thing going on in the business, full stop, and really brings together really a couple of years of work, but we're really proud to announce what we're acutely saying is the restarting of the ADT guarding business, and also the signature security guarding business as well, in Australia. And that is a little bit tongue-in-cheek because we're not actually bringing security guards back to the market under our brands. What we're really using is video technology to provide a guard-like service, and it's technologically challenging to do that. That's why it hasn't really happened in Australia at mass, and I don't believe where it has happened. We've now got the technology solutions in place to do that, and we're looking to really drive that forward. And so, what I say to people, which is often surprising, is 269,000 security professionals in Australia, registered certified security people in Australia. The reality is, 220, 30, 40,000 of those, probably more, are really security guards and patrol people. And if you think about, if you use technology and video, which allows us to see what's happening immediately, to verify it immediately, and then to go to the authorities immediately, as distinct to what happens when you have a guard required to go to verify an event firstly, and then secondly respond in queue to the authorities. This solution that we offer is probably half the price of what people have today when they have a guarding or a patrol service, but it will give you twice the result. And where this is happening overseas, and it's happening with the particular secret sauce that we have in a few markets around the world, you actually impact crime stats. You can bring crime down, and you can do it at incredibly surprising economics and incredibly positive economics for us. So I'm really excited about this business and this line of business and what we can do here. And I think it'll turn into a really significant engine for us and a market-changing position for us as we move forward. In terms of the inorganic growth, the other thing to talk about today, and we set the scene by just talking about where we've come from, is, we have built this business essentially on two turnarounds. One initially was the Threat Protect business, which we, turned into IMG Group, integrated what was in that business at the time, integrated the platforms and put a new platform in place, and then embarked on a journey of scaling that up until we ultimately got the ADT business into our fold, which was also turnaround. And I sort of have to remind people of that, like we have been turning this business around. It wasn't given it to us in pristine conditions, and that's what the last year or so has been, and continued that journey along the way. Now it looks like in a page like this, like a lot of, I guess, movement. What I like to do is refer you back to the sort of third slide, where we have a very clean structure now. We have ADT, Signature, and IMS, and these businesses have all folded in their ways into those businesses. In particular, I guess from a financial point of view, they've been incredibly accretive and attractive, and we continue to see that opportunity. We aren't buyers for all purposes and for all reasons and at any cost. We're very strategic about what we're doing, and in recent times, what we've really been focused on through post the ADT acquisition is that rebuilding of that commercial network in Australia to allow us to really grow and drive that underlying growth. And so we've just raised money, and we've announced the acquisition of DVL. I'll talk about DVL in a second, but we've also over-raised at this point. What I wanted to do was to go to market and sufficiently fund ourselves such that we weren't going to raise, regularly and, I guess have that potentially weigh on us. My ask of the business was, can we please just get ourselves well funded so that I can, continue as it works in with us, and we can be quite demanding as an acquirer from a strong position to work through the opportunity set that we have. And we do have a large opportunity set, and it is larger than this in reality, but we wanted to give a bit of a flavour as to what we sort of see ahead of us and a bit of a timeline that we'll look to work to. And we wanted to make sure we were in a good position to do that, and allow the team as much as anything to just focus on that, because as much as I know capital markets people think that it's you just sort of raise some money and buy a business. There's a whole lot of time, effort, and energy that gets put into that and can be distracting. And I really want for this next phase of the business, certainly for the next 6 months or so, for us to be able to really focus on the business itself and to continue, to drive the journey that we're on. And so in that regard, really, really, really proud and excited to have acquired, or to be about to acquire, DVL. We should settle it at the end of this month. DVL is a long-standing quality security services business based in Perth. It was founded, over 20 odd years ago. They've got a range of long-term clients, high quality clients, particularly really only focused in WA. They have a really stable team of quality technicians. It's just a quality organisation, very similar to the proprietary acquisitions we've bought. And it is a notable sort of feature, I suppose, I'd make about the journey that we've been on. We've gone from, in the early days, having to sort of buy do-me-ups to now buying, really quality businesses, which we're looking to fold in and allow us to leverage what is now an enterprise, national ability to deliver, so that we can unlock actually the organic portfolio that we have in front of us. And so, one of the points I made in the raise docs recently was just to point to both the ACG and AAG acquisitions we've just made. Both of those businesses have extended their existing workbooks with existing customers further than they would have otherwise since we've acquired them. And so that the thesis to which we've been working around being able to actually enhance these businesses as part of our group has been proving to be correct and true up to this point. So, very, very excited to have DVL on. In terms of metrics, it's a $5 million cash and $2 million of sort of script transaction, sort of consistent multiples paid, accretive immediately, to our earnings. But as I say, what we're really excited about is where we think this can position us and ultimately take us over the coming years. And we've gone from being, really not much of a player at all in WA a year ago, with simply ADT, which had very limited resources on the ground in the commercial enterprise space. I'm talking about particularly here. Through to having a really good presence with the AAG acquisition recently, to now having a pretty commanding presence. And so whilst we're not probably the biggest player yet in WA, we would be starting to push up against being the largest player in the market, which ultimately will position us to really unlock again a number of the customers that we already have across our business that are looking for us to have footprint across their networks. So I'll wrap to a conclusion quick and take questions, but essentially, to characterise where we're at the moment, we've really strengthened the balance sheet. We are focused and have been focused on the refinance. We're still, I think I made the point, our current debt holders have enforced the minimum interest period through to February. So, that's sort of become the timeline that we were focused on. We didn't want to sit around and wait for that to happen. So we just wanted to keep moving the business forward. We're pretty focused, ambitious people, I guess, but this has put us in a really strong position with a strengthened balance sheet, which will allow us to continue to unlock the work that we see in front of us. We've got a strong platform that does generate cash. The guarding opportunity, I just put a note, you're going to see more of that. You're going to hear more about that. If you have a property, or people that have a property, whether that's residential, commercial, that could benefit or does have a security guard presence, this is your solution. Come and talk to us. It'll be half the price, and it will actually, capture criminals in the act and actually lead to better deterrence as we go forward. So very exciting. Acquisitions have provided that national capacity. We don't really have too many gaps in terms of now unlocking the portfolio, but we certainly are open and alert as long as we continue to deliver the integration that I expect us to see, and the teams come in and fold in and maintain themselves and grow. A lot of potential in what is a multi-billion-dollar market. We're now coming out of the woods from what was a first intense year with ADT, and I think I made the point at the full year result, like it's hard, I think, for people probably on the outside to understand how much work was involved last year for the team under the hood. We're very focused on delivering a result, which we did, but belied that was an awful lot of work in the business and on the business. And we're now, certainly with the end of the 3G, able to look forward clearly now and actually drive the business forward, as I say, and show growth, which is what's important to me. With an underlying EBITDA of greater than 38, it was, as I say, depending on how you view that 3G piece and what it means or doesn't mean to us in a counter case, which offers pretty strong growth. We're well positioned for the refinance. I am not worried about that, but we are also focused on driving the business forward at the same time. So I'd expect that to come through, and then ultimately drive the cash flow benefits that everyone's been looking for, myself included, with a team that's very focused, and we're working hard to deliver what we're really looking forward to be a pretty special year. So I'll pause there, Mark, and I feel like I've raced through that fairly quickly, and I'm sure there'll be some questions to answer.
Yeah, we've got a couple of questions already. And yeah, one was around guidance, but I think you've pretty much covered it off in that last slide and what you said earlier. So I'm just going to skip over that one for now. Here's one more on kind of broad brush strategy. It's saying you previously mentioned, IMB wasn't a typical roll-up, but now you're kind of talking about, DVL and a couple of other acquisitions, and it's looking more like a roll-up versus a previous plan to kind of deleverage, pay out dividends, possible buybacks, but now you're raising equity for this business or for the DVL acquisition. So maybe just clarify how all of this molds into the current strategy.
So I think what I've said in the past is we are very aware of. So when I hear the word roll up, I think a company that's going to do a bunch of stuff and blow up. And so we're not one of those. What we're focused on is integrating and building a business that's very clear in what it does and has a very clear structure, growth plan. And that's why delivering an organic picture for us is really important this year, because it shows that the things we've brought together have added value, as distinct to just sort of chucking businesses together. And I can say this because that's effectively what Threat Protect was prior to our involvement, and has been seen many times before in the market. In terms of the plan, look, we've got our leverage down to the point where we said we would. So, I mean, effectively, if you go back to the original raising docs, when we did the recapitalisation and consistently through, we've actually hit all the marks that we said we would do. I think what we are saying is that there remains opportunity to add to the portfolio, where it makes sense. And the reality for us is that the integrations in the early phase of the business were very hard. And I've made the comparison to, like, when you merge control rooms and monitoring rooms, it's like merging Vodafone and Telecom, or Telstra. You're actually taking customer bases and platforms, and, it's a really heavy IT integration ask. When you're buying businesses which are largely people and contracts, that's a lot simpler. So this recent phase we've been in has been less complex from a sort of systems and risk point of view, but it's been much more people focused. So, I've been on the road all week. I've been up in Perth with the new team, as has Jeff. We're very focused on the need to bring the teams together to create the consistent culture and things like that. Will we continue to do that? Like we will, where we find value and it unlocks and adds value, but we won't buy things for the sake of buying things. There's no point in that. What we get out of the back of that, though, is a business that does generate very good cash flow, and we will, use that cash flow accordingly. I think one thing that's worth just noting, because I would certainly love it, but it is a reality, is the inverse to having a lot of tax losses is you don't have a lot of franking. So, what happens from a capital initiative point of view is yet still to be determined. And, the board certainly hasn't actually elected to make a decision on that yet. We certainly don't need to de-gear from here. We can continue and will de-gear and de-gear with cash flow, on a go-forward basis. But I don't think it won't be franked dividends will be a feature for the next period, but certainly buybacks and things like that would be. And so I think, if I wanted to characterize where we feel we're now in a very strong position. And, whilst, it's important to me to tell the story, to continue to get support. We've actually got all the pieces, and we've had them before, but I think we've supplemented them in the most recent deals, and they've been accretive and they will be accretive. Whereby we actually have a business now that can power itself. What really focuses my mind, though, is after 3 years to get to this point, I'm sort of focused on the next 3-year picture and going, well, where could we be in 3 years' time from here? And I really wanted to use this phase, and it's all got a little bit messy in the last few weeks, to really not reset, but to refocus on that journey. And I see every possibility, likelihood, without predicting it, that we've got a path through to the sort of ASX 300 should we wish to take it. Now, my comment about that is not, oh, well, I really want to be in the ASX 300. Wouldn't that be cool? It's, I think what we are doing in terms of providing a professional service to the customers we're dealing with, to the recognition of what we do, there's value in that. And I think there is a halo, like what we're seeing in our business is IMG has emerged in its forms. Every part of our business is now starting to benefit in a demand sense, and demand hasn't really been a problem anyway, but from our profile. And so, I think this is a case where we're still seeing benefit from scale and benefit from size. And so whilst that's the case and can be accretive, we'll do it. But my underlying point is, the word roll up does send an emotional response down me, simply because I know what that connotes, and I'm very alert to that. And I think I made the comment here before, but I know certainly other forums, the one thing that I won't leave behind is a business that's a mess, and it needs to be done. And so I can relate that directly to current results. So the first quarter this year, you can see in our cash flows, we did a massive integration project for our business called Project Funnelweb, which was integrating the ADT residential customer base into Signature Security. So we uplifted an entire business unit and put it in another business, and they're all systems and everything, and then reinvested in it. It did result in a number of redundancies, and it had quite a big impact on that first quarter cash. Why did we do that? I didn't probably have to, because I want to make sure the bones are right. We've actually got the structure right to be able to grow into this year. And so as we get through this year now, and we've done that hard work, we're actually in a really good position to execute cleanly, as distinct to sort of try to massage results, in the short term, but actually have a mess, I guess, behind the scenes in terms of the business. And so that's really the philosophy we've got. And that's why, I really was asking for it to be in our hands so that we now can execute at the pace to which we think, we can operate, as distinct to sort of being subject to capital market conditions or whatever conditions, or sort of when people want to. Now the future is very much in this business's hands.
And yeah, just probably another point for people on the other flip of tax losses is when you do generate a profit, there's no actual cash outflow. So while it might look like you're paying a profit, it keeps cash in the business because you actually don't pay the cash tax because it gets offset with the losses. So that's probably something for people to reminder as well. It's the positive of not having franking, I guess.
We don't mind
Just
tax.
a question on the guarding. What's the difference between the current commercial security monitoring service and the new guarding service? It says, for example, if an office, I presume that's an officer an office under current security package has an intrusion, would your monitoring team get alerted automatically and then check the video real time, followed by the necessary actions, including alerting the customers or the...
Really, really important point, this. So if you think about it today, if you buy an alarm system, and it's certainly, you buy it because you need it for insurance, you buy it because it does alert you if there's a problem. So if your existing alarm system goes off, you get rung up and said, hey, something's happened. Now, the reality is it's a beam. It's like you've got a radar. I always liken it to, you're a submarine radar tech sitting at the bottom of the ocean. You get a flash on a screen and there's something out there. Is it a fish? Is it a boat? What is it? You don't know, but something's happened. So you get an alert. Now, if you want to verify that event, you've either got to get out of bed yourself in the middle of the night and go and check it, or we will send out a guard to check it. What won't happen is the police will go, because the police will say, well, 95% of signal alarms that go off are false alarm reads. So they say, until you tell us there's actually something going on, we won't go. So when you introduce camera video guarding and patrols, because you can randomize patrols and do what you like with them, what happens is we can verify that event automatically. Now, this is where the value of the network that we've built comes really to play. We have A1 graded control rooms. So those that have done our investor tours into Rydalmere, you go into the bunker. The reason for that bunker is because it's serious, right? Like, it's bomb proof. We can live in there. If power goes out, we survive. The alarms stay on. And therefore, if we see an event and we call the police, and we can call them more efficiently than you can, they will respond. And so that's how you change crime rates. That's how you actually catch people. And that's how you then ultimately deter. Now, I've got to be a bit cautious, because the business with an alarm system today does work. It does provide value. So I don't want to essentially talk down an existing alarm package. But the reality is, I think what consumers really want, what I know I would want, is I want you to verify the event straight away and respond straight away if it's real. And so the cameras allow you to do it. Now, that sounds simple, but to do that into a control room on scale with thousands of cameras, with feeds running 24 hours a day to actually pick up events, you need pretty advanced, as I say. I want to be a little careful about, us, because we're the one few public sort of companies in our space. It's very easy for everyone in the industry to sit on these calls and listen to me and go, oh, that's a really good idea. So, our secret sauces has got the solution to that, and we can scale up with the best known brand in the market, and that's what we're going to do. So the value, it will cost you a little bit more upfront in a recurring fee sense, but you won't be paying for call outs, because what happens usually is you have to call a guard out. They go check it, say, no, there's nothing on, or maybe there was something on, it's happened. All of those costs drop away. And so you're actually getting a much cheaper solution, but it's much more effective.
Dennison, I know we started late, but we still have run over time, and I don't want to take up any more of your time. So apologies if we didn't get to all of the questions. But thanks once again for coming back and joining us, and hopefully we can get you back on here maybe in February after the next set of numbers come out.
I think we're very looking forward to the picture ahead, and I'm looking forward to rolling up over the next few months, quarters, and years, as we've sort of exited this phase of our journey into the next one.
Yeah, and I'll just mention now that I see it here on the screen. Yeah, if you do have further questions, and I didn't get to them, please drop Rod an email there, Bourse Communications, or Dennison directly.
Great. Thank you very much, Mark. Cheers, guys. Thank you.
Thanks, everyone. Thanks, Dennison.